the blessing and the curse of do-it-yourself investing. You're really doing it yourself. And you're going to evolve as an investor with time. Your thinking and your strategy is going to evolve with time. And I just always had some real estate exposure because I don't personally own any physical real estate. So I said, let me make a portion of my portfolio real estate. And there's plenty of, now there's quite a few real estate or REIT covered call ETFs. REITs tend to be not super volatile, so they don't typically have a lot of yield. But if you look at the last 5 years, 10 years, 15 years, real estate does not beat the S&P 500. Right? I'm talking about REITs here. Maybe if you bought a house in Vancouver at the perfect time, you'll beat the S&P 500. I don't know. It's still hard to beat. So this is why I say whenever I think of, this is why my portfolio is much slimmer now, right? Because there's Canadian banks with covered calls. There's energy company, oil and gas companies with covered calls, real estate and this and that. But if you actually start doing the comparison, looking at the numbers, nothing beats the S&P 500. So why should I take more risk, in my opinion, sector specific risk, when I could just get the S&P 500, get a better return over the long term? So I don't really have much I do have a little bit because there's a tiny bit in the indexes. There's a little bit in the indexes. I think maybe there's 2% in the S&P 500 is real estate, 4%, whatever it is. But I'm not super big on real estate that much anymore. But this is with time. I've gotten comfortable just owning S&P 500 as my baseline, most boring asset is the S&P 500. Right?
And these indices have that self-cleansing nature to them too, right? So like, for example, S&P 500, right now it might be more like technology heavy, but over the years, as different companies come and go, maybe even the sector breakdown might change depending on.
That's why I love the market cap indexes, because if you're better, if you're bigger, if you're stronger as a company, you're more efficient, you have better cash flow, you have better business, you're going to get a bigger percentage. That's what capitalism is. And I believe in capitalism, right? That's why I love the market cap weighted. And it's not going to bother me that tech is 30%, 33% of the S&P 500, and the NASDAQ it's over 50%. I think in 10 years, it could be higher than that, because if we're entering into an AI digital age. So I think, 15, 20 years ago, I'm sure tech was much lower. So to me, people who complain and say that it's too concentrated in tech, I don't understand the reasoning behind it. Well, that's because they're the best companies right now. So they should be at the top. They should have the bigger percentage. And maybe in 20 years, I don't know, maybe it'll be another sector. I don't care. But owning the index market cap weighted pretty much means you're owning the best all the time, forever. I mean, I don't think there's anything better than that, easier than that. You don't have to manage anything. You don't have to rebalance the index. It's like a self rebalancing perfect thing. The best companies in the world, the best economy in the world, the US. And, but this is with time and experience, I've realized this.
Now, of course, you are financially independent, of course. But let's say for somebody who's on the way to getting there and maybe still have an income coming in, depending on where you hold these income generating assets, they might be hit with some taxes, which is fine. Like, you're of course bringing in income, but how do you go about deciding where to invest these funds?
Yeah. So obviously, my tax, I get tax questions. Tax questions are still some of the top questions I get from the beginning. So people need to understand, that's the cool thing about covered calls, first of all, because in Canada, call premiums, which is 90% plus, 95% plus of the income you're getting with these covered calls, and sometimes 100%. Like, for example, a Tesla one or a Palantir or tech stocks, they have no dividends. So by default, all the income that you're getting is actually classified as capital gains or ROC. So call premiums in Canada are classified as capital gains, which if you're making over 100K in Canada, typically, that's the most tax efficient source of income. It's capital gains. And of course, the higher you go, the more you want capital gains. Lower tax brackets, Canadian eligible dividends are good. But in terms of taxes, Any registered account, TFSA, RSP, Lira, taxes don't matter. It doesn't matter if it's regular income, eligible dividend, it doesn't matter. If it's an ETF that's listed in Canada, it's all tax-free. The TFSA, all the income is tax-free, all the growth is tax-free. In the RSP, all the dividends and growth is tax-free. Of course, when you start withdrawing, it's all taxed, no matter what the source was, as regular income. So for all the registered accounts, doesn't matter. The key is the cash account, the regular non-registered account, aka the margin account. There's a few names for it, but the real name is a non-registered account, which means it's not registered with the government. You can do what you want in there. You could go crazy, right? It's beautiful. No one looking over your shoulder, no limits, none of that crap, right? So the best thing I could tell people is go to taxtips.ca, look at your province, look at your tax bracket, and that's where you're going to see how you're taxed on regular income, which is the worst. Regular rental income, salary income, and income from fixed income. Bonds is the worst. It's regular income. But then you have Canadian eligible dividends, and then you have capital gains, and you have ROC. Now, ROC, very misunderstood. It's not taxed. It lowers your ACB, your cost base, and you get taxed on it as capital gains when you sell in the future. Okay? So I always tell people ROC is in the same tax umbrella as capital gains. It's kind of like delayed capital gains until you sell. So what's better, eligible dividends or capital gains / ROC? That's always the $1 million question in tax account, in a cash account. And it really depends on your province and tax bracket. But normally after 100, 120, what you really want is capital gains or ROC. So that's why covered call ETFs, which primarily give capital gains or ROC, are very tax efficient. Sometimes even more in higher tax brackets, more tax efficient than Canadian eligible dividends. So that's how they're taxed. Now, of course, if you're a doctor, I talk to doctors, I talk to lawyers who are already making, $200,000-$300,000 or more. And in Canada, we all know the tax problem in Canada. We won't discuss it. So maybe, if their TFSA is full, their RSP is full, they're going to get hit on taxes. So maybe if you're really, really in a high tax bracket, it's best or better to go with growth oriented funds that have like no dividends, where you could sell them later on when you actually retire in your lower tax bracket. So there are some tax considerations, but covered call ETFs, covered call income is very tax efficient income because it's all capital gains and ROC. That's why whenever you go to like an covered call ETF, in the description, you'll see tax efficient distributions. That's why. So don't let taxes ruin your mind completely. Don't worry about it in the registered accounts. And the non-registered is where you have to think a little bit more of it. But you're only going to touch a non-registered if your TFSA is full and your wife's TFSA is full, basically. Right. And there's the RSP as well. Some people don't like the RSP. I still think it's a good account. There's a debate there, but that's how they're taxed, basically, these covered call ETFs.
Yeah, so try to, as much as possible, if you have that option, prioritize using those tax registered accounts that is available to you, because there are some benefits for sure to them.
That's for everyone, whether you're an income investor, a dividend investor, a growth investor. You should always start with the TFSA is literally the best gift the Canadian government will ever give you. It's the only way in Canada, the only way. There's only one way. That and being a criminal, it's the only way to have tax-free income. That's it. There's no other way. So max out your TFSA religiously, like the 2nd of January. I say the 2nd because the 1st the market is closed. You always got to make sure to max out your TFSA with good quality assets. Don't take too much of a high risk in your TFSA, I would say. Some people get lucky, right? They invested in Tesla and now they have $1 million TFSA room. But I know people who went with cannabis stocks and they destroyed their TFSA room. So go with something steady, Eddie, in your TFSA. And if you start early, you could get to a couple $100,000 in your TFSA. And then, you could generate thousands of dollars a month of tax-free income, which is great.
Yeah, that would be awesome. One of my last questions for you, Adriano, for those new investors that are just getting started, some of them may be interested as well. Like, hey, you know what? I want to explore the domain of passive income investing. Maybe I want to get to the level that Adriano is right now, like how early he got to that point. What are some of your advice to them that you would provide?
Stay disciplined, stay consistent, and whether you want to be an income investor, cover call investor, a growth investor, dividend investor, many of the core concepts are the same. I think all investing styles work. I think there's three major ones that people need to consider, and you could also mix and match: growth, dividend, where you're just focusing on dividend paying companies, and income, which prioritizes income with covered calls and other vehicles. But just the first thing you need to understand is that long-term investing is not risky. People think of stock market stocks investing as it's risky, I might lose money. Look, have you ever met Mo? You tell me, have you ever met anyone in your whole life, and do you think you'll ever meet anyone in your whole life that has lost money investing in the S&P 500 for a long period of time? It's
No, I don't
literally
think.
kind of like
Yeah,
impossible, right?
yeah.
So you have to understand the difference between speculating and investing,
Hmm.
because investing doesn't get any attention on the news, doesn't get any attention on the YouTube channels, because it's freaking boring. Let's be honest. What I do, I feel, is boring. Okay, investing in the
Boring, but does
S&P
the job, right?
500,
Yeah, yeah,
it's nothing special. You're investing in
yeah.
the whole economy of the US, the best companies in the world. Yeah, but it's only the US. They have international footprints. Okay, a lot of their revenues are coming
Mhm.
from outside the US. You're not investing in the US dollar. You're not investing in the Trump administration. You're investing in the eternal best companies in the US that will always exist. And if some of them start doing bad, they'll go down in the index. Some of them start doing good, like Palantir and Tesla, they'll go up. It's a meritocracy index. It's beautiful. Start with
Yeah.
that as your baseline. I don't care whether it's growth or income, cover calls or not. I would say know the difference between speculating and investing. It's a long-term thing. You're in it for a long time, forever. Stay in and consistently buy every month as much as you can.
I couldn't have said it
That's
any
the
better, Adriano. Yeah, 100%. For me, for our household, I don't know if you know, but we mainly invest in XEQT. I think that's pretty much 90% plus of our
I did see
entire
that.
yeah,
Are you
household.
planning on holding XEQT forever?
I would say for at least for the time being. So I do see myself maybe holding on to it at least for the next 5 to 7, 8 years for now. But who knows? Like, I'm the type of investor as well. Like, I always keep an open mind. Like, that's why I'm doing these type of interviews. That's why I want to learn different perspectives. And to me, and sometimes folks ask me like, hey, when you go on these interviews, make sure you ask about NAV erosion and all of that. And it's like, yeah, I mean, it's a very hot topic. I know it's been talked about a lot, but at the end of the day, I'm on the mindset that one approach to investing doesn't make the other approaches wrong. I think there's merit in different approaches, and ultimately, I think staying curious, staying knowledgeable, and learning from different people's experiences, and then you customize and personalize it to what
E-
works best for your own family, for yourself, and your household.
Exactly.
Nothing wrong with
Exactly.
that. Doesn't mean that if I'm successful, others are wrong, or vice versa. I don't see it that way whatsoever.
Yeah. So the NAV erosion thing, I have videos on it. I talked about it a lot. I believe it's a myth because when people mention NAV erosion, they don't really understand how these funds work. You have to understand, if we take HHIS as an example, or any covered call ETF that has 12, 13, 14, 15% yield, the stock charts are not impressive. They're never going to be impressive. What people don't understand is that HHIS, for example, right now the monthly dividend is 25 cents. The stock's about just near the $12 mark. They give out 25 cents. The 25 cents a month comes, the easiest way I could explain it, every month the stock 25 cents comes out of the stock price, comes out of the net asset value, the NAV, and is given to you, the investor. Every month, 25 cents, 25 cents, 25 cents, 25. So over the years, you maybe HHIS, the stock price is going to look flat. Maybe it'll go down a little bit. And capital wise, if you look at a stock chart, I'm down 5%. The stock is down 5%, 10%. looking at the stock chart, you will not see all those 25 cents being given out to the shareholder. You actually see it being removed. So NAV erosion is a myth because the 25 cents a month or whatever it is for any covered call ETF is not eroding. Erosion means it's disappearing, right? It's disappearing. It's being given out to you, the investor, as cash. So why is it eroding? So to debunk the whole NAV erosion myth, I ask people, look at the total returns, not the stock price returns or the price return or the stock chart. That will solve your NAV erosion myth. This
And I
is
think
my opinion.
sometimes the concern as well is, which I think the more I think about it too, Adriana, sometimes people think, well, compare the total return, compare the total return. You're gonna not have the same total return. But I think you earlier on, right at the beginning of the talk, you touched on that you're not looking for necessarily trying to, like you did even mention, there is a chance that it might, when it comes to total return, it may underperform. But you're comfortable with that because you're getting that consistency of income. Is that fair
Exactly,
assessment?
because your priority is not total return. Maybe your
Yeah.
priority. So my personal priority is both. So this is why I always invest now in the ones that have covered calls and 25% leverage.
Hmm.
Because my priority is also total return. I don't want to sacrifice a lot of return by getting that income doing those covered calls. It's almost guaranteed you'll underperform without some sort of leverage. So this is why I like the 25% hands-off leverage. I don't have to worry or manage myself. So I could get similar total returns to the underlying, right? But if you're not comfortable with the leverage and you're investing in an S&P 500, like a USCC or a QQCC or an SMAX, you'll get similar performance to the S&P and Nasdaq, but probably less, because most likely, if not guaranteed, less, because over time they go up. And covered calls means you're giving up some upside. Plus, covered call ETFs have higher fees because they're higher to manage. So higher
Yeah.
fees, giving up upside. Of course, over time you'll have less performance. But like you said, it's for some people the priority is income. For me, it's both. I like to say that it's both. Now, for your XEQT, there is a covered call version and there's a covered call 25% leverage version as well, which is maybe very interesting. So people who love the idea of just buying the whole world, that's why you get XEQT. I want 100% stocks. I want 100% equity, right? This is not a 60-40, 80-20. This is 100 stocks
Exactly.
all over the world. And like what, maybe 55% of it is US
US is,
approximately.
I would say, 42%, and then Canada is around 35%, and the rest 5%, and the international, the
There you
remaining
go.
parts.
So
Yeah.
if maybe, you have a growing audience, I don't know how big your audience is, but let me just give you some income or covered call equivalent and something for you to think about as well. Global X Canada has some of the best index-based covered call ETFs, and most of them, if not all of them now, they have 25% leverage version. So their Vanguard has VEQT,
Mhm.
BlackRock has XEQT, ZEQT is BMO, FEQT is Fidelity. I think there's maybe one more.
TD
Kind of,
has
they're
as
all
well, I
trying to
think.
do the
Yeah.
same thing.
Yeah.
Global X has HEQT, which is
Okay.
competitor to XEQT. Now they also have EQCC, which is the covered call version,
Hmm.
but they have EQCL, which is the leverage covered call version. So it's kind of like getting XEQT with covered calls and 25% leverage. And right now it's yielding about 12%.
Very
Now,
interesting.
if you don't really care about the covered calls, you don't really need the income, my recommendation for you is, you probably know about HEQL.
I've heard about HQQL, yeah, but didn't look into it
HEQL
as closely. Yeah.
is simply HEQT, which is identical, if not very similar, to the XEQT and
Yeah.
VEQT with 25% leverage. So it's
Leverage.
growth.
Yeah.
And it actually has a monthly dividend, which is pretty cool, I believe. It's only 2% because there's no covered calls.
Yeah.
But this is why I asked you how long you're going to hold XEQT.
Yeah.
Because if you think you're going to own it for 5, 7, 10 plus years,
Hmm.
why not get a little bit of leverage that's hands off? That's leverage costs are cheap in Canada. right?
Were you
It's
thinking almost like, especially for somebody who's not yet 100% sure, maybe giving it a try? It doesn't have to be you full on transition, but maybe
well, let me put
have
it
a
this
small
way.
portion, just explore it, right? Kind of thing.
If you're going to hold it long term and you think it's going to go up long term, you're going to be better off much more likely with the
Leverage.
25%
Yeah.
leverage version. But of course, if the market crashes, it's going to go down 25% more,
Yeah. I hear
but
you.
also up
Long
on
term.
the upside. So this is designed, this kind of leverage, this little bit of leverage is designed for long term. You
Hmm.
know, there's different types of leverage on the US. Like Global X also has those 2x, 3x daily reset leverage.
Wow.
That's
Yeah.
not what this is. That's insane. That's 100, 200% leverage reset daily. This is 25% regular borrowed money for the long term. So just a little tip for you, my friend. I would highly consider, if you like XEQT, check out HEQL.
Hmm.
This is not a sponsored video,
Hmm.
but I really believe, whether your income or growth, in that 25% leverage if you're planning on holding it for 10 years plus.
Where can folks follow you, learn more about the services that you offer and your essentially your contents?
Yes, passive income investing is my YouTube channel. I release videos at least twice a week. I have some monthly series. I unveil my portfolio every single month there. And we also have a website, passiveincomeinvesting.ca. I do have two digital products, which come with lifetime updates. You could check out all the info there. And I also offer a one-on-one coaching session as well, which they sell out very quickly, which is still surprises me. But if ever, I get a lot of people who are interested in the strategy. They get an inheritance, they're about to retire, they sell a property, they sell a business, they get a big lump sum, they don't know what to do with the money. That is my number one coaching session type. They get, a settlement or whatever, so they could always book a call with me, and they could ask me all the questions they want. Instead of spending hours and hours and hours watching all my videos, that could be convenient for people if they do want a one-on-one with me, because I have a lot of experience with how these ETFs work.
That's fantastic. Thank you so much, Adriano. Looking forward
My
to
pleasure, my
connecting with
friend,
you
and
on
continue the
Blossom.
good work on Blossom and educating and have people on. I mean, this is knowledge that should be shared. Everyone should have it, and it's people like you that are putting in the time and effort to help educate. That it's a good thing. It's a good thing.
Appreciate it, Adriano. Thank you so
All right,
much.
buddy.
Have a great
Take
rest of your
care.
day.